So you guys might already know this, but success in investing isn't guaranteed. In fact, many studies have basically said that 80 to 90% of investors end up losing money. And many of these failures can be attributed to a lot of very common investing mistakes. So today I want to dive into some of the worst investing mistakes that you could make and how you can avoid them. This is going to be about investing in general. It's not just about stocks, it can be in real estate too. So I'm going to talk about it in different scenarios. So first, mistake one is neglecting diversification. Diversification is fundamental. It basically involves spreading your investments across different asset classes to reduce risk. So if one section of your portfolio isn't doing well, maybe another part is going to do better, so then it kind of balances itself out. But a lot of investors fall into the trap of trying to maximize their gains by putting all their money into just one asset. Now, there are going to be some people who do really well by doing that, but for many others, it's not a very good idea. So what I like to do, for example, is I invest in real estate, but also in stocks, ETFs, index funds. I even have a little bit in crypto, and I have a high yield savings account. So I have many different investment types. Even within real estate, I invest in different markets. So I have properties in Texas, California, Florida, and Georgia. If one market isn't doing as well, maybe another one's gonna do better, and it kind of balances itself out. This is a random story. I remember I was at this crypto event, and this one investor was putting all his money into this random crypto coin, and he was putting all his life savings into it. He was working 2 jobs, getting like 5 hours of sleep, trying to put all the money into this one thing. I think he even took money out of his house to put it into this thing. And who knows, maybe that'll work out, but in my mind, I was like, that is insane. That is so risky, especially if you have a family. You take all the savings and put it into this one thing. It's almost like gambling and hoping things will work out. What happens if everything tanks and that coin just goes away? He would have lost his entire life savings. You would really harm your family. So putting everything into one thing is extremely risky. So that's why I do advocate diversifying, making sure that you reduce the risk of major loss. Mistake number 2 is to sell early. Something that's very common is panic selling. Studies show that panic selling can often lead to negative emotions associated with investing. You guys might know this quote by Warren Buffett. It's be greedy when others are fearful, and be fearful when others are greedy. This basically means that instead of selling during a market decline when everyone's scared, panic selling, all these different things, consider it an opportunity to make smarter investment choices and perhaps buy when everyone's scared. Panic selling is really common and can lead to impulsive decisions, but if you look at historical data, you'll see that markets eventually rebound after downturns. A lot of people are looking at a very small time frame. You gotta look back and see how much the market has grown, whether that is in stocks or in housing. It's basically the same. Both markets have had this appreciating trend. So I am more of a long-term investor. I like to hold on to assets, never sell, and just ride the wave. Mistake number 3 is constantly listening to predictions about the market. Well, the truth is there's no crystal ball. No one can 100% predict which way the market's gonna go. But despite this, there's always gonna be articles trying to convince investors about what's gonna happen. If you're constantly listening to what people have to say and you're just day trading all the time, chances are you might fall into that 80 to 90% of investors who lose money unless you're a day trading expert. So instead of just listening to other people and making rash decisions, you got to do your due diligence and really study companies, study your investments. When it comes to real estate, study the market, study the cash flow numbers, and see if it really works for you. Don't just constantly listen to what people say, because everyone's going to have their own opinions. Mistake number 4 is ignoring tax implications. So this is one of the most overlooked aspects. Well, different types of investments have different tax implications. For example, long-term capital gains, which are profits from selling an asset you've held over a year, are taxed at a lower rate than short-term gains. So understand that if you're constantly selling stocks, you are going to be subject to capital gains taxes. Same thing with real estate. If you're flipping homes, you're going to pay capital gains on those properties. So maybe you want to hold on to them long-term and perhaps not even sell them. Real estate also has tax benefits that you want to learn, and Roth IRAs have tax rules that you might want to take advantage of. So you got to learn these different tax strategies so that you can make the most out of your investment. Understanding these different things is going to affect your net returns. It's not about how much you make, but it's also about how much you keep after those taxes. So it's very important to study these things and possibly consult with a tax professional. Mistake number 5 is trying to time the market. This is basically related to the predictions point. to the panic selling point. And usually what happens is you end up selling at the bottom and buying at the top. So here's another quote by Warren Buffett. It mentions, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That's why I advocate long-term investing, where you're investing in strong companies or you're investing in ETFs and index funds that are well diversified and just riding the wave. Same thing with real estate. Just ride the wave, let it appreciate over time. Which goes to my next point. Mistake number 6 is investing in companies you don't understand. This applies to real estate as well. You don't want to invest in an area that you haven't studied. Now, if you're going to invest in a stock, you're going to want to understand a company's business model. You're going to want to understand the revenue sources, market dynamics. Don't just blindly invest. Make sure you invest in something that you really understand. And the last mistake I'm going to mention is neglecting to rebalance. So what does that mean? Over time, the market moves and it can throw your portfolio off balance and your asset allocation might change. So maybe you wanted 50% stocks and 50% real estate. Well, maybe things appreciate in value, things go down in value, and now you have a different percentage in your portfolio. So understand what you want for your percent in stocks, maybe percent in bonds or in real estate or in crypto, as well as your cash savings. And also your investment goals and risk tolerance may change over time. So for example, maybe you're in a wealth accumulation phase and you want to buy a bunch of properties, buy different stocks. Whereas when you're older, maybe you're just in the wealth preservation phase and you're not going to invest as much anymore. Your risk tolerance is lower, you're retired, so your investment goals may change, which means maybe your portfolio is going to change over time. So constantly figure out your strategy moving forward. So I hope you guys enjoyed this list of mistakes that I've compiled. Investing can be amazing. It has changed my entire life. It has allowed me to become financially free. But make sure you avoid these different pitfalls like panic selling and trying to time the market and things like that. By avoiding this, you're going to increase your chances of success. If you guys like this episode, smash the like button, comment below if you have made one of these mistakes before, subscribe, hit the bell button to be notified of my latest videos. I'll see you guys in the next one.